Welcome into Market Takes. Man, I know you could have been anywhere in the world, but you're here with me. I appreciate that. I am Dion, Rabouin, reporter at the Wall Street Journal. Today, we are breaking down the jobs report, non-farm payrolls, and man, this is an exciting one. It's one of those days where the data is showing a lot of things. The markets are moving all around. We got some big reactions. I love days like today, so I appreciate you all being with me today. This report has very good news and it has some very worrisome news. We're going to break it all down right here on Market Take. So we're going to talk about what the jobs report showed and how it compared to expectations. Talk about some standout numbers from the report because there was a lot to get into. The market had some strong reactions. We are going to talk about those market reactions, stock, bonds, currencies, big reactions in the FX currency market, crypto commodities. Across the board, you had some big moves in the market in response to this jobs data. We're going to talk about all that. We're going to talk about how today's data fits with some concerns about the labor market that had been ongoing. We put out a video just yesterday on my channel about some weak signs underneath the headline numbers in this jobs, in the labor force that I've been seeing and that other economists I talked to have been seeing. Watch that if you haven't. It's on the channel. And of course, we're going to talk about what's next for data because we are always looking forward, even though it is backward looking data. So listen, let's get into it. The jobs report for January showed 353,000 jobs added last month and the unemployment rate dropping to 3.7%. Let's put a chart up here on your screen right now so you can see what we're talking about. Not just 1 month. If you look at the last 3 months, we are seeing a clear trend. You saw employment gains kind of bottom out there in October. You had been seeing a decrease, right? If you go to the left side of your screen and you work to the right, you're seeing lower highs, lower lows. That was the theme going into really the end and the fourth quarter of 2023. Then we hit that fourth quarter of 2023, and what do you see? You see those numbers start to pick up. On the right side of your screen, you're seeing a re-acceleration. This month here, this January number, the strongest we had seen since January of last year. Now, there's some weird intricacies and changes in terms of adjustments that the Bureau of Labor Statistics makes to its data. So we don't want to get too far into that, but we see 353,000 jobs added in January. You see 333,000 jobs in December. That was revised up from 216,000, right? You see 182,000 jobs added in November. That was revised up from the previous month. All of payroll employment from 2023 was actually, previously it was 225,000 jobs a month. Well, now it's 255,000 jobs added per month in 2023. That is a significant revision. So the big thing here is not just that this month was a blowout number in terms of way more than expected, almost double the expected rate, and the unemployment rate stayed low, didn't pick up as expected, but those last 3 months, or those last 2 months, were revised higher, and so we see an even stronger pace of hiring. And this chart just illustrating, again, the overall theme. It had been lower, now it's moving back higher. So that's what we're seeing. We're seeing a change in the regime, a change in the trend in terms of what's going on with jobs. But there's always a but, right? When you're looking through the data, you got to read the fine print. We're going to dig into the fine print right here on Market Takes because that's what we do. There are some indicators that are a cause for concern. Let's talk a little bit about those. First one is wages. Let's throw a chart up here on your screen so you can see what I'm talking about. This is the Atlanta Fed's wage growth tracker. Now, what we had seen coming from 2021 out of the pandemic, 2022, started 2023, those wage gains just going higher. Folks getting 5, 6, 7% increases in their wages. And the average, this is the 3-month moving average, right? So this really takes a lot of the noise out of the data. Even with that, even with a very sober statistic like this Atlanta Fed wage growth tracker, you just see a big kind of hockey stick growth, something you really don't see. You see downward growth in that 2008, 2009, going into 2010, that global financial crisis, the Great Recession, and you're seeing just kind of the opposite of that out of the pandemic recession. And what you've been seeing over the last few months, really we saw 6 straight months of declines in wage growth, and then you saw a few straight months of that just being flat. And we've seen that flattening, and the question is, are we going to rise higher, or are we going to continue to go lower? And that was a big question. So this chart just illustrating again where wages had come from. We've been going up, then we came back down, and now we're kind of stagnating. Well, today's report suggests that we could be going back up. Average hourly earnings rose 0.6%. That was twice the expected rate. Now, that turns out to a 4.5% year-over-year increase in wages. That's the highest since September. So the Fed has said, and Fed Chair Jerome Powell has said very clearly, he wants the wages and he wants earnings for U.S. employees to come back into a more normal pattern. He wants to see, quote, normalization. And that means wage growth to come back down around where it was during most of the 2010s. We're still well above that, but it looks like we could be re-accelerating higher because the wage gains we saw last month was double the expectation and puts us back on a trajectory where we were in September when wages were much higher. Here's the other piece of that. Now, that matters because it puts pressure on inflation. As wages go higher, you could see inflation start to pick up. And we did see last month in the CPI inflation report, inflation picking back up to 3.4%. There also was a decline in labor force participation, and we're going to talk about that in just a minute. 175,000 people dropped out of the labor force. The rate was unchanged, but a lot of people dropping out of the labor force. The mix of higher wages and fewer people in the labor market, that tends to put more upward pressure on wages overall. We'll talk about that in just a minute. Want to really quickly we're going to nerd out here just a little bit, talk about one quick thing, the household survey. That happens when the Bureau of Labor Statistics calls up people at their house. Hey, what's going on, man? You got a job? Does your wife have a job? Your kids? More and more, we're hearing people say no. I don't have a job. My wife doesn't have a job. Uncle Benji doesn't have a job. Bobby's sleeping on the couch. He ain't got a job. Things are looking kind of rough. We saw the unemployment rate holding steady at 3.7%, but that hold was for the wrong reasons. We saw the number of people employed decline by 31,000. The number of people employed has now fallen in 3 of the past 4 months, including a decline of 683,000 people in December. Now, the number of unemployed was down. A number of unemployed people fell by 144,000, but not because they got jobs. They didn't move to the employed category, right? There's 3 categories. There's employed, unemployed, not in the labor force. All those folks, employed was moved net negative, minus 31,000. Unemployed, minus 144,000. That equals the 175,000 people who were moved out of the labor force. So people dropping out of the labor force. And that accounts for the decline in both employed people and unemployed people. So people aren't getting jobs, they're just saying they're unemployed. And the amount of time people are spending unemployed is staying longer. We also have seen layoffs start to pick up. The Challenger job cuts report showed 82,307 cuts in January, a 136% increase from the previous month. That's significant. Really quickly, be aware, my man Lou Breen, he is the economic strategist at DRW Trading. He says, quote, be aware that this month's data has benchmark revisions and population updates in the 2 surveys. Also just want to throw this out there, disclaimer, new revisions to the BLS models and adjustments. And also the last 3 years, the January jobs number has been revised by literally hundreds of thousands of jobs each month. So when we talk about that, we're talking about January 2021 was revised 10 times higher. The original report said 49,000 jobs added. By the time they made all the revisions, the monthly, the annual, the revision that they just made, it actually was 494,000. So from 49,000, the original report, to 494,000. That happened in January of 2022 and in January of 2023, where we saw hundreds of thousands of job differences between the initial report and the revisions. That's significant. Now, we want to talk about significant. Let's take a look at what's going on in the market. I want to put the markets up here on your screen. This is WSJ.com. This is our market data. As we're seeing right now, the S&P and the NASDAQ still holding on to gains for the day, but you can see there is some uncertainty there. You see the market moving higher. Overall, the Dow is lower, but when we look at the S&P, you saw that big jump out of the gate, and then you see kind of coming down, coming up, uncertainty. The bond market. Now, the stock market, you know me. If you watch market takes, the stock market, those are the frat bros of the market. The bond market, this is where we're seeing big moves. The most traded of all the treasury bonds, this 10-year note right here. And you see a huge jump after the release of this jobs report. And now we are again moving higher. So those yields moving up, that's a sign of worries about inflation. That's also a sign of potentially more growth. Lots of things baked into this. But this kind of move right here, this doesn't happen on its own. This happens when there's a big change in the data that we could be seeing a regime shift, and that's what this jobs report tells us. Everyone was expecting the Fed to cut, maybe as soon as March. Fed Chair Jerome Powell came out on Wednesday, told us that's off the table. Now it's looking like may even be uncertain with all these job gains. This is a big move. And on this 2-year note right here, you are seeing another significant move. I also want to take you back to this 10-year right here because the move we've seen in the price change, that's almost 2 full points. That is a huge move on the bond market. We're also seeing big moves in the currency market. You're seeing the US dollar index. Again, you see that same big move that you saw on the yields, significant moves. Let's talk really quickly about commodities. Because what we've seen here, you're seeing across the board in the red. Usually you don't see the same thing of these reports on economic data moving the market for commodities this significantly. We see it right here. This is all right around the 8 o'clock hour. You see it in oil futures. You see it in gold. And that really is all about, you see it in silver as well. Silver down about 2.5% right now. And that's all based on what's happening in the dollar. There are now expectations for the value of the dollar to rise. All of these commodities are measured in dollars. So gold, oil, copper, all these things are priced in dollars. And when the value of the dollar starts to rise, the value of those commodities declines. And that's what we're seeing. So we're seeing not just the move in the dollar, but the expected future moves in the dollar really pricing themselves out across the commodity market. And that just, again, illustrating the move that and the strength and the importance of this jobs report that we got today. The market is reacting in a big way, and you can expect to see those changes in the market continue going forward. So let's talk about the big picture, right? The Fed said on Wednesday, Fed Chair Jerome Powell came out and said, we like what we're seeing, inflation is moving the way we want it to, the data is moving the way we want it to, but we need to see more. We need to see more evidence that inflation is coming down and will continue to come down to our 2% target. And this here jobs report, it ain't it. This is not it. This is not the evidence the Fed is looking for. So we saw a big market pullback. You saw the NASDAQ down 2% after the Fed came out and after Fed Chair Jerome Powell came out and very strongly put some cold water on expectations for a March rate cut. We could be seeing a similar transition or a similar trend play out again. The stock market is again still up right now, especially the S&P, the NASDAQ, trying to regain some of those gains they lost on Fed Day. But keep an eye on a move today, midday, as some of those big traders start to come in and start to rethink what this jobs report means. Because again, what we are seeing is strength in terms of hiring, lots of jobs added, but there's a lot to be worried about within this report. So big question is just, the Fed doesn't need to raise rates to disrupt the market rally that we're seeing. The Fed just needs to not cut rates or not cut rates as quickly as the market is pricing in. Fed Chair Jerome Powell didn't say we're not going to cut rates this year. He just said we're probably not going to cut them in March. Well, now May comes into question because are they going to cut them in May? And if they don't cut them in May, maybe they don't cut in June. Maybe they don't cut in July. Market's price was pricing in 6 rate cuts for this year. The Fed only has 10 meetings. They already didn't do it once. If they don't do it in March, that's twice. That's 8 meetings for 6 rate cuts. You start to wonder about the math. And if the Fed's not going to cut rates significantly, some of these high valuations on the market don't really make a lot of sense. And that's what the market could be thinking about. So let's get back to this jobs report and some of the numbers in there because I talk about reading the fine print. Let's talk about the fine print. Let's throw a chart up here on your screen about average weekly hours worked. What do you see? You see a trend moving lower, and then this past month you see a significant decline. And we actually remade this chart this morning because the drop was so significant. We're seeing average weekly hours worked drop to the lowest since March 2020. You guys remember March 2020, not a good time. And this just illustrating, you can see very clearly on your screen, we had been moving lower and then we saw a significant move lower. It's small, but when employers start reducing hours, that's a clear sign there's worries about the overall labor market. There's clear signs there's worries about the economy. Another sign, let's put up the labor force participation rate there on your screen. What do you see? You see it picking up through 2021, 2022, most of 2023, and then what happened? We're moving down lower. So like I said, the labor force participation rate didn't decrease this month. It held steady, but we did see 175,000 fewer workers during the month. And that just illustrates, again, a worrisome trend for the overall market, for the overall jobs market. Right now, what we're seeing, 175,000 people dropping out. A tight labor market with 3.7% unemployment should be bringing more people in. It should be adding people, but we are seeing consistently fewer people employed. We're seeing more people moving out of the labor force. That's not good. Another thing, into the details of this report, the number of discouraged workers who are marginally attached to the labor force, who believe that no jobs were available for them, that increased 452,000 in January. That's not the sign of a strong labor market, a strong jobs market. That's not what we're seeing. So this report shows us job cuts are happening, layoffs are happening, hours are being reduced, but wages are increasing. That could be all part of the same trend. Listen, when layoffs happen, they typically affect lower wage workers. And so when those lower wage workers are laid off, that brings up the average earnings for a company. If you make $100,000 and I make $50,000, we work at the same company, well, our average is $75,000. But if I get laid off, well, now our company's average is $100,000. Similarly, if I work 40 hours and you work 20 hours and I get laid off, our average hours worked was 30, now it's 20 because you're the only one there. Think about that as we're talking about the labor market. So what comes next? Well, we get the U.S. Services PMI report on Monday. That's big. We have seen solid numbers on those PMI reports, those purchasing managers indexes or business surveys. That's going to be important on Monday. Watch that. Consumer credit. I keep telling you, I'm pounding the table trying to tell you to watch consumer credit. Watch these delinquencies. Watch these credit card numbers. We are adding a lot of debt personally to our balance sheets here in the U.S. Watch those numbers. That's on Wednesday, February 7th. And then on February 13th, we'll be right back here for Market Takes. Make sure you join us. That's going to be a big one. CPI, inflation, February 13th, 10 a.m. You're going to want to be here. Don't be anywhere else. And for more, check out my podcast, WSJ's Take on the Week. We cut through the noise to explain the major business and financial news that moves markets. Also, you can make smarter investing decisions. Subscribe wherever you get your podcasts. That's going to do it for us here on Market Takes. Hope you'll be with us and join us when we do it again next time.